in the beginning of the crisis, it seemed like regulators wanted to blame crypto instead of the significant rise in interest rates and the deposit outflows. Now we're seeing it as a solution to the problem, but the regulators are still reticent.
Renowned financial manager Cathie Wood expressed disappointment in the Federal Reserve's steep interest rate increases over the last year, stating that they shook up ARK Invest's approach like an earthquake. In addition to examining the recent upheaval in the banking sector, Wood commented on the future of Bitcoin. She was impressed by how Bitcoin responded differently from the stock market during the recent banking crisis. Wood emphasized that the ongoing crisis was not brought on by cryptocurrency, despite increased scrutiny of the sector, following FTX's collapse and the resulting regulatory clampdown. Cathie Wood expressed how severely her strategy has been impacted by the valuation hit, which she attributes to the Federal Reserve's 19-fold increase in interest rates in less than a year. According to Wood, this is an unprecedented development that has caused significant disruption. In light of the current situation where deposits are leaving the banking system for the first time since the 1930s, Cathie Wood drew attention to the asset-to-liability mismatch that is typically common for banks but now untenable. With deposits offering a higher interest rate of 3% 5% compared to securities earnings of only 1% 2%, some banks, including SVB, had to sell held-to-maturity securities, resulting in losses that impacted their equity accounts. To stay up to date with our latest updates, don't forget to subscribe to our channel and hit the bell icon.
I think they're addressing the liquidity issue, but not really the solvency issue from our point of view. A couple of things have happened here that have never happened really in history, and so the banks didn't expect it. The first was interest rates up 19-fold in less than a year. Never happened. Under Volcker, which it was twofold, 10 to 20%. And the low base does matter. Many people dismissed it, saying, oh, just such a low base. No, expectations were low base. So that was the first. We've never seen that magnitude of an earthquake, I would say. Then the second thing that no one expected, again, because it hasn't happened in such a long time, was deposits leaving the system. For Silicon Valley Bank, it was venture capital facing a funding drought, and so they had to draw down their deposits. But then for others, you've got money market funds paying much higher than deposits, attracting flows. So that combination was lethal. And so now they have the backstop in. Now what do we have? We have they're going to be paying up if they're depending on the facility. They'll pay roughly 4.37% right now is that rate, OIS plus 10. And that's much higher than many of them have been paying for deposits, number one, while in the case of Silicon Valley Bank, their average held-to-maturity security on the asset side of their balance sheet was only 1.6. So they're going to see net interest losses. Now, instead of having mark-to-market hit equity, these losses are going to hit earnings.
In a Bloomberg interview, Cathie Wood shared her thoughts on the recent price surge of Bitcoin, stating that its behavior during the crisis could attract more institutions to invest in it. She also noted that Bitcoin's movement during this time was distinct from that of the equity markets, making it an interesting case to observe. Cathie believes that Bitcoin is the ultimate defense against wealth confiscation and serves as an insurance policy for developing countries. She also thinks that affluent individuals can benefit significantly from Bitcoin by utilizing it as a safeguard against inflation-induced confiscation.
Innovation solves problems, and you showed a few charts at the beginning that suggest that some of the innovators out there are solving problems. I mean, I think the most dramatic example of it to us was the behavior of Bitcoin last week. It absolutely took off. It was a flight to safety vehicle. And so it is really proof of concept that innovation solves problems. There are, in Bitcoin, fully decentralized, fully transparent, auditable, which is addressing all of the banking's problems right now. And so a flight to safety, a little bit of an insurance policy. There's no central point of failure in Bitcoin.
Cathie Wood pointed out that liquidity tends to dry up during a crisis, which can negatively impact assets. However, in a recent report, ARK Invest recommended that institutional investors should allocate 2.5% to 6.5% of their portfolio to Bitcoin, which Wood considers a reasonable percentage. According to ARK's Big Ideas 2023 report, the base case price prediction for Bitcoin by 2030 is $682,000, while the bear case is over $250,000 and the bull case is nearly $1.5 million. Wood believes that the base case price prediction is quite conservative. Recently, ARK Invest announced that it has raised $16 million for a new private crypto fund.
One of the things that happens in a crisis is liquidity dries up, so that tends to hurt assets. And the fact that Bitcoin moved in a very different way from the equity markets in particular was quite instructive. You'll find the building blocks of those price targets in our Big Ideas 2023. So ARK Big Ideas 2023, and they are, for the base case, I would suggest quite conservative. We've dialed some of them down since last year. I know that corporate treasuries pulled away from Bitcoin because the regulators were pulling them away from Bitcoin on their balance sheet. So we've pulled back there. But we do believe that the behavior of the price through this crisis is going to attract more institutions, for example. We've done a report targeting institutional investors and the allocation that they should make if they care about this new asset class diversifying their portfolios. And I believe it's somewhere between 2.5% and 6.5%. So not crazy. These are the sorts of allocations they would have made to emerging new categories of assets like real estate in the 70s, emerging markets and small cap in the 80s and 90s. Governor DeSantis basically said that he was going to allow, I don't know if he said this exactly, but the conclusion of his saying we're going to set Florida apart from the rest of the nation was this ability to touch companies that touch crypto. After all, these are cash deposits. They're fiat deposits. They're not crypto. And this can be done on a state-by-state basis. So
Cathie Wood has argued that deflation is a more significant concern as prices continue to decline. She disagrees with the market's fears of rising inflation and the tech bubble's burst. Wood believes that inflation and higher rates should not be feared, as inflation has been declining steadily since its peak in 2022, when prices surged at their fastest pace in 41 years. The recent drop in inflation has been mainly attributed to the decrease in food and gasoline prices. However, this decline highlights the increasing signs of inflation's retreat.
Coming down quite dramatically, some by 70, 80%. And I would also say the retail call was very right. I think you'll agree on that. The discounting, we think, is going to continue to work its way through the system from the commodity price level to downstream near the consumer. And you can see this. Tesla is cutting prices. Many people say, oh, it's because of competition. No, it's because their commodity prices are coming down. And Elon's even talking about deflation. And the cost associated with innovation is coming down because it follows a learning curve. So I think the innovation that our companies are delivering are going to be one part of the deflation. Commodity prices, another. And I will also tell you, the yield curve, the week before last was down, inverted by as much more than 100 basis points. That also is a deflationary signal, as is what's now going on in the banking system. Yes. I think the banking system is fearing deflation.
The banking crisis has led many to anticipate a relaxation of the Fed's tight monetary policy. Cathie Wood observed that the majority of market innovations have been created after 2001, resulting in lower costs and more sophisticated products. She noted that while the situation may seem familiar, those who placed their bets on long-term lower inflation and interest rates were the ones who came out victorious. What do you think will be the impact of recent banking crisis on the cryptocurrency market? That concludes our discussion for today. We'd love to know your thoughts in the comment section below. If you found this video informative, please give it a big thumbs up and don't forget to hit the bell icon to stay updated with our latest videos. Thank you for watching.